Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
Nasdaq at all-time highs. S&P 500 pretty darn close. The S&P 500's up 90 basis points and it's 71.27. The Dow Jones Industrial Average up 82 basis points, not percentage points. That'd be a big move. It's at 49,551, up 402. The Nasdaq up 1.3% at an all-time high. Sitting at 24,576. The Russell 2000 up 2/3 sitting at 2783. The VIX, there's not a lot of volatility right now. It's elevated, but not stressful. At a reading of 19. Gold is sitting up 2/3%, sitting at $4,751 an ounce. Bitcoin, a lot of people think this is a strategic move and that it moves higher from here. If it can hold 79,000, that's where it's at now. Somewhere between 78 and 80,000 is a technician's idea that it's put in a bottom for the year. Crude oil's up 2.4%, sitting around $91 a barrel. 10-year Treasury sits at 4.29%. That's been interesting. It's been elevated this year more than we thought, with expectations of rate cuts. There's some huge winners today and some big stories. GE Vernova up 12%, up $120 to $1,112. Boeing up 3.7% to $227. That's helping the Dow Jones Industrial Average. They're trimming their losses. They're increasing their backlog. Google is revealing 2 new AI chips to heat up the rivalry with NVIDIA. I got all this and much, much more today. Stay with me. It's going to be a good show. Year to date, Brent crude is up 54%, silver up 8%, gold up 9%. They're the big winners. Russell 2000 for the U.S. market's up 10.2%. A Morgan Stanley All-World Country Index up 4.4%. So those are the big winners. Nasdaq's up 4.4%. The S&P 500 up 3%. The Dow Jones Industrial Average up 1.5%. Oh boy, did you hear any of those hearings with Kevin Warsh yesterday? Just incredibly boring. He says there's no deal with President Trump to lower rates. The president never asked me to predetermine, commit, fix, decide on any interest rate decision. I don't think anyone really believes that. If he had a nose like Pinocchio, it would have cracked me up. Otherwise, those hearings are incredibly boring. This morning, United Airlines is cutting their 2026 earnings forecast. I think that's worth hitting in just a minute. One more tip of the hat to Tim Cook, who turned Apple into a 20-bagger. United Healthcare yesterday beat earnings estimates and hiked its profit outlook. That's what we want to see. Now, United Airlines is what we don't want to see, where companies are lowering their earnings expectations. United slashed its 2026 outlook as it's grappling with a surge in jet fuel prices due to the Iran war. CEO Scott Kirby said demand remains strong. United said that it could earn between $7 and $11 a share. That's down from $12 to $14 a share. So those numbers are going to come out of the S&P 500 earnings expectations. That's what you don't want to see. You don't have to own United to care. It's a big company. United, like others, is trimming some of its planned flying this year to reduce costs. Lower capacity can drive up airfare. With fewer seats on the market, the carrier said it expects its revenue to cover between 40 to 50% of the fuel price increase in the second quarter, as much as 80% in the third, and between 85 and 100% by the end of the year. So they expect its revenue will cover between 40 to 50% of the fuel hike second quarter, 80% in the third, and 85 to 100% by the end of the year. That's what high price oil is doing. And again, when we started this war, I give Trump's administration some credit. They said it's going to be 4 weeks roughly. I don't give them any credit for saying it's over roughly 48 hours into the event. And now 6 weeks later, it's definitely not over. The Strait of Hormuz is a mess. The deal that Trump ripped up with Iran years ago that Biden had set up, or Obama, I'm sorry, to pay them to not enriched uranium to pay them for their uranium. Seems to be what we're headed back towards. So we never needed to do this. But I don't know. I don't know politics well enough. Let's get back to what I do know. Best Buy slides on CEO transition. Here's what's interesting about this. Analysts are worried that it's status quo and they wanted someone from outside the company. So Jason Bonfig is going to succeed Corey Berry as CEO. Best Buy CEO transitions highlights a tension between continuity and the need for renewed growth with an appointment of Jason Bonfig, signaling confidence in the company's existing strategic framework, but falling short of catalyzing the investors out there with enthusiasm. He's got operational expertise. It means he's going to be an efficient leader with initiatives and enhance the customer experience. But the broader backdrop of normalized demand and cautious discretionary spending further raises the stakes for execution under new leadership. Ultimately, the focus is going to shift to Bonfig's early messaging and ability to articulate a compelling path towards sustainable growth beyond operational optimization. They're going to be hit, Best Buy, by higher DRAM prices, keeping some customers out of their stores for phones and laptops. But also their current appliance selection isn't jumping out and making people excited. Boeing's first quarter numbers look really good. Top and bottom line beats. Record backlog levels across its commercial defense and services. Cash flows improved. They're expecting certifications for the 737 MAX and MAX 10 this year. Positive steps. Stock probably has some upside. I own it in S&P 500 type funds. I don't own it individually. So I'm happy to see it. Again, back to the United story, I'm not happy to see them cut earnings because ultimately I want earnings to go higher. GE Vernova turned in a complete blowout. Their stock's up $130 today, up 10%. It was a beat and raise first quarter. Backlog increases, all-time highs on the stock. Revenue rose 7% year over year. EBITDA jumped 87% as margins expanded 390 basis points by stronger pricing, better volume, and productivity across power and electrification. Orders were an impressive $18.3 billion, up 71% year over year, while backlog climbed to $163 billion, giving the company much better visibility across gas power, grid infrastructure, and electrification. These are secular tailwinds. They're very clear, especially from electrification, data centers, grid modernization, and gas-fired generation. GE Vernova said data center-related electrification orders in first quarter were already larger than all of 2025. Stock is powering to an all-time high. The message from this quarter is GE is not just beating, it's also scaling into stronger multi-year growth. Capital One had a missed earnings and revenue. They had a one-time Discover acquisition-related amortization and integration expense. Barclays raised its price target on the company to 250 from 225. That's when you say it wasn't the smoothest and easiest quarters with that one-time charge, but we can see that's going to be exactly that, a one-time charge. Strongest sector out there today so far that I can see is technology. S&P 500's up 90 basis points. It's up 1.5%. There's continued bargain hunting in software stocks, lifting the iShares expanded tech software ETF IGV up 1.79% towards its best close since early February. The Philadelphia Semiconductor Index is up 1.7%, extending this month's gain to 29.3%. There's some leadership from solar names in technology after the EU Commission called for an accelerated shift to alternative energy sources. Exactly opposite what the United States is doing. So Enphase Energy up 4.5%. Company's expanding its virtual power plant capabilities in Australia. First Solar is reclaiming some of the losses from yesterday, up 3%. Micron's up 5%, rising to a fresh record high. Company is calling on Congress to restrict sales of chip tools to China. China has a situation where their government spends a lot of money on their private companies. In theory, the United States doesn't have that, although the Trump administration wants to help out Spirit Airlines. Another big story, and this is how big of a day it is, because I can't believe I haven't hit these two already. I'm going to hit Google in just a second. But Adobe announced a $25 billion buyback, up 4.1%. Will agentic AI, will the visualization tools, the making of slides, the making of annual reports via AI, will they hurt Adobe, who owns that industry pre-AI? Now there's also another company called Figma. So Google announced chips this morning for AI training and inference in the latest shot at NVIDIA. Google said the changes will come with its 8th generation TPUs, making specialized chips for each task. BMO Capital said Alphabet is one of the best ways to own AI. The world is short compute, and NVIDIA will still get its fair share. Google rolled out a flurry of announcements today at its Cloud Next 26 event. The company announced its new 8th generation TPUs called the TPU-8T for training and the TPU-8i for inference. Earlier generations of TPU chips were used for both training and inference, but now each of these two tasks is handled by distinct hardware. They are on it. If you think Google's just search, you're missing out. They've got a great AI platform. They got great email platform. And now they have great chips. Holy mackerel. So Anthropic recently announced a partnership with Google to access 3.5 gigawatts of TPU computing starting in 2027. Google also announced a new Gemini enterprise agent platform, which replaces its Vertex AI product. Google isn't exactly going head-to-head with NVIDIA's much more powerful chips, and it's still offering them as part of Google Cloud to customers. Google and NVIDIA also announced a partnership to deploy the most advanced Vera Rubin chips on Google Cloud via Google A5X next-generation AI infrastructure. Later, I'm going to go over what I considered a wacky press release. It was essentially tied towards Pepsi signing a big deal to get into the Google's cloud. Was it Google's cloud or Amazon's cloud? Oh, now I got to get it right. Google Cloud. I'm going to go into some of the details on that because I was like, let's show people how AI is going to benefit Pepsi, who makes Doritos and sodas. Some more research out of Wall Street today. Seagate is being brought up by Barclays. They see upside in the storage memory cycle. They're upgrading Seagate to overweight on 40 terabyte ramp. They lift their price target to $625. It's currently a $574 stock, up $15 today. Analyst Tim Long said, we see the most value in storage memory hierarchy in the drive names, and we see both earnings and multiple expansion. The duopoly industry structure commitment is not to add capacity and significant pricing upside. All make us feel like there's another leg to these stories. Wow. They're using triple-digit kind numbers of growth. As Seagate moves to 40 terabyte, this dynamic changes where the company drives material density improvements for structurally similar BOM, driving better EB growth and cost advantages. We like both names here, but upside to Seagate. There's also Western Digital, ticker symbol WDC. Price target for Western Digital goes to $405, for Seagate to $625. Another AI play, Meta Platforms, looks clean in their quarter, according to BMO Capital Markets. BMO's Brian Pitts said, while Meta's broader fundamental story appears clean into the first quarter 2026 results, we believe continued uncertainty around Meta's AI story and increasingly fragile regulatory environment cloud the near-term story. So they're saying their CapEx and the potential that they're getting sued by states and governments around the world is a problem, or a potential problem. But BMO's going on saying potential upcoming headcount reductions in May could support the near-term fundamental story. We believe investors remain focused on and concerned about how Meta plans to monetize $132 billion of CapEx in 2026 without a clear near-term revenue opportunity. Unlike the hyperscalers, which lease out their equipment, BMO Capital Markets, Brian Pitts, has a $730 price target on Meta. He wants to see some clarity on the AI story / opportunity. So he calls it a market perform. That's not an insulting number. I've seen some analysts as high as $850, almost $900, but numbers have been coming down on Meta recently. Morgan Stanley downgraded Zscaler to hold from buy, cutting the cybersecurity stock price to $155 from $200. More competition in the secure access Service Edge, also known as SaaS, S-A-S-E. I tend to think that Zscalers, there's nothing wrong with. I don't know it intimately. I know CrowdStrike and Palo Alto Networks more. And there's some retail investors who are big Palo Alto Networks fans. Some are big CrowdStrike fans. Wolf Research analysts said they're undeterred by the Netflix engagement debate. The analysts argue that the core engagement at Netflix is a positive, and if things stay that way, the streamer will be able to continue to raise prices in the coming years. Wolf also cited Netflix's continued global expansion as a positive. That's a stock I would always look at if it's down 10, 15 to 20% from its highs. And if I were to be honest, if it's down 15 and I buy some, I would consider buying more if it goes down 20%. Elon Musk has shifted SpaceX goals ahead of the IPO. The New York Times took a close look at Elon Musk and how he's reshaping their priorities ahead of a highly anticipated, potentially record-breaking IPO. Shifting aims before an IPO would be unthinkable for most corporate leaders who tend to focus on their core businesses and try to project steadiness to potential investors, but Musk is unpredictable. Let me give you an example on some of these priorities that are shifting. The old target for SpaceX was Mars. The new target is the moon and Earth's orbit. The old target was transportation and rockets. Now it's AI, data centers, and space manufacturing. He wanted to get humans to Mars by 2024, is what he used to talk about with SpaceX. He missed that. Now he wants space-based AI within 3 years. It's going to be a hell of an IPO in June. That's coming up. When I say a hell of a, I don't know if I'm going to partake. I know a lot of you are. SpaceX agreed to acquire AI coding assistant Cursor later this year for $60 billion, or pay $10 billion for our work together. NVIDIA CEO Jensen Huang has called Cursor his favorite enterprise AI service. SpaceX owns both the rocket company and Musk's xAI, which has the Grok chatbot, which is... Does anyone talk about Grok AI? To be fair, no. So SpaceX working closely together with a fast-growing coding startup, Cursor, to create the world's best coding and knowledge work AI. It's a pretty bold move. $10 billion for our work together, up to $60 billion if they acquire them. The news comes as SpaceX prepares for a blockbuster IPO. That's a big line on your balance sheet. I'm going to take a break here. Coming up, I got Patrick O'Hare, and then I'm going to go into how Pepsi could use AI. Interactive brokers. This bullish market, maybe a market update. It's more top stories of the day, like Citi launching an AI avatar. I'll run through a little bit more on what's happening in the market. So I got a big show for you planned today. Stick around. Coming up, Patrick O'Hare.
The markets are more volatile than ever. Inflation, interest rates, global uncertainty. If you have $500,000 or more invested, ignoring it could cost you your future. At EP Wealth Management, they offer a free preliminary financial plan, a chance to identify potential risks in your portfolio before the next downturn hits. Get insights from Chad Burton, CFP, and Rob Black, trusted voices in financial planning and retirement strategies. They'll help you spot hidden risks, rebalance thoughtfully, and uncover opportunities to grow and protect your wealth even in turbulent times. Their goal? To help you feel more confident about your financial future during uncertain times. Don't wait for the markets to decide your future. Schedule your complimentary preliminary financial plan at robblackshow.com. That's robblackshow.com. EP Wealth Management. Plan smarter, live better, no matter what the markets do. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
Joining me now, Patrick O'Hare from Briefing.com, a reliable source of domestic and international news that I've been using for 25 plus years. The site has evolved nicely, and yet it stayed true to its nature of just getting a lot of information from the economy to the stock market to hot IPOs or IPOs. I don't want to even say hot growth stocks, value stocks. They have it all. Patrick, how are you today?
Hey, Rob. Good morning. I'm doing just fine. Thanks.
Let's take a look at the markets. And It seems that we are doing quite well. We're melting up during a war. There's that Trump always chickens out mantra coming from Wall Street in the last couple of days where he wants a ceasefire, it looks like, and Iran wants to be a sticky thorn. And Wall Street seems to like this. Who would have guessed?
Yeah, that's a good summary. Who would have guessed?
Who would have guessed?
I'm not sure really anyone even had on the bingo card when their look-ahead forecast at the end of 2025 that we'd have to be at war with Iran. And sure enough, we are. And I certainly would bet that no one, even if they had said as much, would have thought we'd be at record highs in the major indices had that been the case. So that's a really remarkable trait of resilience, but it reflects the markets, the collective wisdom of the market, thinking that this will get resolved in short order without any prolonged adversarial effects on the global economy and certainly on U.S. earnings. We can debate, I guess, all we want as to whether that's going to be true or not, but just as a market analyst looking at how things are unfolding here, that is the message of the market. And it's rooted in large part on the enduring faith in the impressive earnings estimate trend holding up for the S&P 500.
You just brought the earnings into the conversation. We are getting pretty deep in earnings. The financials did their part last week. This week, we're getting a little bit more color. Today, we're going to get Tesla. What are your thoughts on the earnings so far? They seem to be surprisingly better than expected. Like, I didn't even know 2026 was going to be this good at the start of 2026, 3 or 4 months ago.
Yeah, they've definitely been better than expected. I can look to FactSet source here, the blended growth rate for the S&P 500 so far for the first quarter. And what the blended growth rate is that's the taking into account the actuals for the companies that have reported the results and pairing those with the estimates for the companies that have yet to report, is up to 14.2%. When we posted our earnings preview on April 10th, the estimate was at 12.5%. So definitely better than expected. You have a growth rate for calendar year 2026 pushing up to a little over 18%. Second quarter growth rate that's up over 20% now. So this is the nexus in terms of why the market is seeing through a lot of the geopolitical noise, because there hasn't been any clear signs or clear warnings that would make the market question the viability of those aggressive growth estimates. It's not to say we can't get a warning in the future here that would change that dynamic, but there's a lot of faith in those earnings estimates, and a lot of those are being tied to the idea that the rise of AI will drive productivity gains that helps fuel this earnings growth. And there's a lot to be proven yet in that respect, but there's a lot of hope in that expectation. And that's why we're again now talking about a market that's again not flirting with, but it actually has high valuations here. We had seen some multiple compression when the war started, but now we're back up close to 22 times forward estimates that are predicated in large part on the huge upward revisions to, let's just say, a handful of companies out of the memory chip space and some of the energy stocks. So some questions around whether the earnings growth is as strong as it's made out to be. When you invest in an index fund, it all counts. And you've seen a very positive reaction here in the market because the earnings have continued to come through. So
I think you brought up two thoughts, and I want to hit both of them before we wrap up today. You talked earnings, and you didn't say it, but I'll say it. S&P 493 versus the Mag 7. Next week, we get the Mag 7, and their earnings are expected to be brilliant. But the other thing you brought up is the market seems to be overlooking. One of the things is oil still considerably higher than it was starting of the year, and that should add problems down the road. Try to reconcile those two, or work through those two for me if you can for the next few minutes.
Of course, the energy companies are going to obviously benefit from those higher energy prices. And so that leads to some upward revisions for those particular companies. There's no question that while the S&P 500 earnings in aggregate are looking very strong, it's driven in large part by the results from one or two sectors. right? The information technology sector is expected to contribute a little over 10 percentage points to that 14% growth rate. The financials sector, a little over 3 percentage points to that 14% growth rate. The rest of the market is either little changed upward or downward, really. So you have two sectors that are really accounting for all of the earnings growth. So if you're not invested in those particular sectors, maybe returns a little bit more challenging. But the way we look at the market, we have to look at it through the lens of this broader S&P 500. And that's what I was getting at, though, is that if you're invested in an index fund, yeah, we can throw daggers at some sectors and we can throw accolades at others, but it all goes into the same pot. And that's what's been driving that index to record highs. I think the rebound we've seen in these mega cap leaders here in the month of April is in fact tied to an expectation that they are going to continue to come through with some really strong results. But also in an environment of uncertainty, like we're seeing here with the geopolitical situation, it's an environment where one should be favoring quality and not chasing the speculative plays. But we're getting a little bit of both these days because the worst case scenario is not unfolded here in the market's mind with respect to the Iran situation. And so the market is very bulled up, so to speak, and is just falling back on what it knows best. It's to buy the weakness, and it's to chase the winners, and to be fearful about missing out on further gains. And that's riding this idea that the trend is your friend until it isn't.
It's interesting. I just read a white paper about AI. Joe Davis from Vanguard, he's an economist, and he's throwing out the idea of in the next year or two, we're going to give up on the Mag 7 or the AI play. It's probably bigger than 7. And we're going to shift to Europe, and we're going to shift to small caps and mid caps and value stocks, because all of those will benefit from AI and see the productivity gain. So he's throwing that argument out there. He's saying it's the biggest thing since electricity, bigger than the internet. I don't know. Do you have anyone that you go to and for him to say, buy Europe, buy value, buy small cap, buy everything other than that has AI tied towards it now, and it's going to benefit. It seems like a leap of faith, but it also seems to be like, that's the thesis here, that we're all going to benefit, even areas that have underperformed the S&P 500 in the last 15 years. Do you have anyone like that you go to?
Not necessarily. I think a range of opinions, and this one, I have not been familiar with this one, so I'm glad you did bring it to my attention, and it sounds like a very cogent piece, a thoughtful piece.
I'll email you.
But thank you. But I think in terms of that broader argument, it's one that's been made for a long time, even if we take AI out of the equation. It seems when you've had such a good thing in one spot for so long, it's like you want to seek out other opportunities. But on a relative basis, yeah, everyone's going to be benefiting from AI, but again, the market action of many years now has demonstrated that you want to be where the leaders are, where the growth is, where the strong productivity is going to be, and that continues to be the United States. So one should have exposure to all these other areas in a diversified portfolio, there's no question about it. But there's nothing yet to demonstrate, we think, why you would be strongly overweight those other areas vis-a-vis the United States as it pertains to the AI play at this juncture, because it is in its nascent stages, and it's going to be U.S. companies that are going to be leading this effort and already are. And eventually others will get their turn. But so far, I think we would be inclined to remain situated more in the United States on the AI play versus other areas.
Anything that you're working on, anything that you want to add to wrap up our segment? Any insights?
Yeah, one thing we did touch upon a little bit at the tail end of last week's interview. I'm actually not going to be posting a big picture this week due to some work conflicts, but I will pick up again with the next week. But I was talking about how we have to keep a close eye on the real average hourly earnings. We've seen a number of companies that have announced price increases. And even this morning, United Airlines CEO Scott Kirby said they're effectively going to be able to pass through these higher fuel costs, and that's ultimately going to mean higher ticket prices for consumers. And I think this is, again, the risk here as we look in the months ahead, that if real earnings stagnate, if not decline, and you've got companies that are still dealing with an energy price shock, there is earnings risk out there, but it's just not in the numbers yet. But it's something that we're keeping a close watch on here. And if you get real earnings that stagnate, you're going to get consumers that either have to dip into savings or simply stop spending as much in a discretionary way. And that will have some knock-on effects here for a number of companies and their ability to meet these high earnings expectations.
Thanks very much. It's Patrick O'Hare with Briefing.com, a reliable source of domestic and international news you can use. Source that I've been using for 25 plus years now. Start my day with his page one, end my week with his big picture. It's a big site with lots of information, lots of data for you to use and decide how to apply it to your finances. Check it out at Briefing.com. I'm Rob Black.
This interview featured on The Rob Black Show is brought to you by EP Wealth. Learn more at robblack.com.
That was Patrick O'Hare. Now let's take a look at how the markets are doing a little bit later in the morning. S&P 500 up 81 basis points, staying where it opened at. A little bit higher, but not much. The Dow's given back a little bit, up 64 basis points to 49,464. The Nasdaq up 1.2%, on pace to close at an all-time high, 24,565. The Russell 2000 up 0.5% at 2778. Stocks are rising after Trump extended the U.S.-Iran ceasefire indefinitely. But the truth is the timeline is dicey. It doesn't feel as if what we're hearing through the media channels that Iran is on the same page. We're waiting for them to give us a peace proposal from maybe multiple of their factions, the military, the clerics, the Congress, if you will. So oil is rising on an elusive peace deal outlook. The Trump administration this morning trying to do something to help an American company ultimately is hurting many American companies. And it shows you the unintended consequences. Low-cost airlines are plunging today on a report that the Trump administration is close to a $500 million rescue deal for Spirit Airlines. Trump administration is close to that rescue deal. So you're seeing Frontier Airlines down 12%, ticker symbol ULCC. Allegiant Airlines, ticker symbol ALGT, down 5.3%. JetBlue down 6.5%. And Southwest down 3.4%. The U.S. government could soon loan Spirit up to $500 million in return for warrants to take a sizable stake in the airline, which has filed for bankruptcy twice since late 2024. Carriers made efforts to emerge from its latest bankruptcy, but fuel costs amid the war in Iran have upset that math. On Tuesday, President Trump told CNBC he would absolutely love somebody to buy Spirit. Adobe has approved a $25 billion stock buyback. Will it be enough to soothe shareholders is a good question. The program, which lasts through April 30th of 2030, was announced during an investor session at Adobe's annual conference. It might offer a morale boost. Adobe, like most software as a service providers, remains susceptible to concerns AI could upend its core business. The company is still viewed as a leader in creative software. Adobe recently buckled under competitive pressure and market skepticism. I'm doing this podcast completely with Microsoft's Recorder free, a microphone, a Blue Yeti, probably $109. And then I use AI software to edit out my ums and cut down my long pauses when I'm looking for a number. I don't use Adobe Audition anymore. Citi is launching an AI avatar named Sky. This is what we are looking at for the next maybe 5 years to look for productivity gains and for big enterprises like Citigroup to say, we're going to cut down on labor, we're going to increase profitability, we're going to increase productivity on the labor that we do have by using artificial intelligence that can improve financial advisors' productivity and attract new clients to its wealth management business. The AI avatar that appears as a woman with short hair and a blazer in its first iteration, Sky, the bank says, is an always-on AI-powered team member designed to respond to clients' questions about their financial lives around the clock. In a video demo, Sky walks a client through options for a certificate of deposit account that's come due. Sky updates him on his daughter's college fund is allocated and raises the option of scheduling an appointment with his human financial advisor. Sky also reminds the client that the Fed's recent interest rate decision has implication for mortgage refinancing. It's okay. It's not simply a chatbot. It has all the time that a client requires, and clients can interact with it on their own terms. It looks to be a little on the low end at this point in time as far as wealth management, but it's certainly a direction the world's going in. The nice thing about working with a financial planner is you get more for less. It's a pretty consistent thing where more features come out and then the fees get compressed. And then a few years later, more products come out and the fees get compressed. Precision is non-negotiable, and hallucinations are a real deal breaker. So they can't have this make mistakes. Citi is the third largest lender in the United States. They plan to start making Sky available to its Citi Gold clients this summer. The bank will eventually roll out the agent to clients who use it in the workplace wealth business. Then to its private bank for the ultra-wealthy. Citi's wealth business oversees some $676 billion of client investment assets. That's one area where we're going to see AI try to help industry. There's more. I saw this morning that Pepsi has deepened its AI capabilities with Google Cloud. A little bit of a press release for sure. Multi-year collaboration. But here's how AI can help Pepsi, a beverage and Doritos company. Faster decisions. Pepsi can pull data from sales, inventory, marketing, and supply chain in real time. Have AI summarize what's happening, like Gatorade demands picking up in Texas. It could recommend actions instantly, like shifting inventory, adjusting prices, pushing ads. Less lag between data and decisions equals more sales, less waste. Another area where AI is going to help Pepsi is helping them move billions of products globally. It's a supply chain optimization, huge money here. Predict demand by region and store. Optimize delivery routes to create better fuel savings and labor savings. Reduce out of stocks and overproduction. That 1% to 2% efficiency gain could equal hundreds of millions in savings per year. This is why the stock market's going higher for AI right now, but why I believe in the next few years, you're going to see the rest of the economy move higher as well. Some other areas where AI is going to help Pepsi. It's going to analyze which products sell best by store, by time, by weather. Recommend shelf placement and promotions. Help sales reps prioritize which stores to visit first and when. This is where Pepsi wins or loses against its Coca-Cola on-the-ground strategy. Marketing that actually converts. AI can help Pepsi use hyper-targeted ads for people who buy Mountain Dew and Pepsi Zero. Faster campaign testing and iteration. Personalized promotions. Less waste in ad spend, higher return on investment. The internal productivity, it's underrated, but employees will be able to query company data, automate reports, forecasts, and presentations, reduce manual work across finance, HR, ops. Fewer hours equals more output equals better margins. It can predict equipment failures before they happen in the manufacturing side, optimize production schedules, reduce energy usage. That would be a powerful margin expander. The Gates Foundation is sadly reviewing Jeffrey Epstein ties. Considering Gates was considered like the dark overlord running Microsoft and what he did to other software competitors, he did a pretty good thing starting the Gates Foundation with his ex-wife, Melinda. They launched an external review, though, of the philanthropy's past ties with notorious sex offender Jeffrey Epstein, the Wall Street Journal reported yesterday. The Gates Foundation is going to have to cut costs, 500 jobs, or about 20% of its staff by 2030, citing an email that the staff received announcing about the job cuts and the Epstein ties reviews. Gates said, "This is a challenging time for our organization in many ways, but it also highlights the critical importance of taking the tough actions now." That's what the CEO, Mark Sussman, said in a memo, not Bill himself. The Gates Foundation has a 2026 budget of about $9 billion. They plan to cap operating expenses at $1.25 billion. A little sad, in my opinion. I'm not going to cry, but they do good work. And it's a poor way to go down. The speculative boom is back on. The AI boom supporting players is surging again. Now, an AI boom speculation would be names like Bloom Energy, Oklo, and Nebius. You're also seeing a ridiculous run in quantum computing stocks. IonQ up 3.3%, Rigetti up 1%, D-Wave Quantum up 3.7%. Beyond Meat, heavily shorted stock, is rising 4.3% today. Be careful. A market rally invites a lot of temptation into speculation. I would just say be careful. Earnings are set to surge 18% this year. I think the bull market has room to run. Can't tell you 18 months from now, but I feel pretty good about 6 to 12. Stocks are hovering around new highs. It appears the market has put the Iran war in the rearview mirror. It isn't just the second quarter. A lot of investors worried the Middle East conflict would derail the bull market now in its fourth year. Earning strength makes that unlikely. There's a built-in cushion for the pattern to hold, even if earnings per share this year and next is more modest than current forecast. It would have to fall far, indeed, for it to dip into the high single-digit range. Earnings per share is expected to expand just under 18% this year and nearly 17% next year. That's pretty good performance. When you get double-digit earnings per share growth for 2 years, and you go back and check the index's total returns for the first of those years, there are only 5 times in the first year. Wound up being a down year for the S&P 500. A lot of focus is going to be on next week's earnings from Alphabet, Meta, Microsoft, and Apple, amongst others. Join me as we go through this journey. If you have any questions, anything you want me to highlight on the show, drop me an email, rob@robblack.com. Don't forget about signing up for the next event. I've got 2 events coming up in the next 2 months, one each month. One's a Pints and Portfolio, and the other one is going to be a seminar with CFP Chad Burton. You can sign up for the events at robblackshow.com. I'll be back with the afternoon podcast. Find it where you find my podcast, Rob Black Show.
The markets are more volatile than ever. Inflation, interest rates, global uncertainty. If you have $500,000 or more invested, ignoring it could cost you your future. At EP Wealth Management, they offer a free preliminary financial plan, a chance to identify potential risks in your portfolio before the next downturn hits. Get insights from Chad Burton, CFP, and Rob Black, trusted voices in financial planning and retirement strategies. They'll help you spot hidden risks, rebalance thoughtfully, and uncover opportunities to grow and protect your wealth, even in turbulent times. Their goal? To help you feel more confident about your financial future during uncertain times. Don't wait for the markets to decide your future. Schedule your complimentary preliminary financial plan at robblackshow.com. That's robblackshow.com. EP Wealth Management. Plan smarter, live better, no matter what the markets do. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.